forward. What moves on the minutes? Maybe nothing does. Maybe we see a massive move. Trying to answer that question, I think, is going to be an interesting challenge today. Obviously, foresight is a useful commodity in these markets. Michael McKee is here to help us out, Bloomberg's international economics and policy correspondent, and Ira Jersey, chief US rate strategist for Bloomberg Intelligence, joining us down the line as well. Ira, I'm going to start with you. Let's talk a little bit about what you're expecting from the minutes and what could be the outcome. Where do the surprises come from?
Yeah, we know that they're going to mention that they talked about the balance sheet and the future of the balance sheet. I think the question is, how much detail do they give us about those discussions? And do they give hints about when they're going to start reducing their balance sheet and by how much? We think here at Bloomberg Intelligence that they will start very early this time, and particularly because there's so much excess liquidity in the financial system right now that it's going to take a year before they'll basically be tightening monetary policy by letting its balance sheet run off. So we think that they'll start pretty early. But the details of how they're going to do that will be important, because presumably they'll do it passively again, like they did during their last bout of quantitative tightening. And in doing so, we estimate that'll take, like I said, a year for that excess liquidity to drain off. Then it will be tightening. Now, what's going to move on that? I think that the rates market are more or less expecting something like that. So I don't think you'll get a big move in the rates market at this point. But I agree that risk asset markets might see some volatility on the idea that they're going to start this early balance sheet reduction.
So does that mean that in terms of just the bond market, you feel like if we're at 78 basis points for the 2 and you're looking at 165 for the 10, that we're priced for that?
Well, the market's anticipating at some point in, say, the next year and a half that the Fed is going to start balance sheet reduction. So part of that is priced into the market. I think where you'll see the big move is not necessarily the level of rates, but you probably will see a little bit more curve flattening, because if the Federal Reserve is easing out of the market in general, then that means short-term interest rates will probably go up a little bit faster than longer-term interest rates. I think during the course of the year, in general, we're going to see higher interest rates, not as dramatic as we saw during the course of the entirety of 2021, but you will see a lot of curve flattening, because as the Fed both starts to hike and then secondly starts to reduce the amount of liquidity in the system, both of those things will conspire to have short-term interest rates go up a bit faster.
Mike McKee, are you on the same page with Ira Jersey when it comes to the talk about reducing the balance sheet? How early does it come? How does the sequence work as well? Could that provide a surprise too?
The sequence and how they do it could provide a surprise. If they give us significant information about it, I think what you'll get is the Fed laying out options, probably from the staff, and they will continue to talk about it at the January 27th meeting. But one of the big questions, as Ira pointed out, is when do you do it? They waited 2 years after tapering last time to start reducing the balance sheet, and then they had to stop when they went too far. But as far as the impact on the markets and what moves, Ira talked about the bond market. Let me just point out, in the equity market, the last time they did this, the last time they started a quantitative tightening, it had no effect on the S&P 500. They went 2 years of tightening, and the stock markets just continued to go up. What happened is they went a little too far down in terms of the size of the balance sheet, and some of the short rate markets started to seize up, and Jay Powell was forced to reverse course because that fed into the stock market. But right now, they're not there yet. The question is, when do they start, and what do they start tapering? We could see, if they decide to start with mortgages, a change in the mortgage rates that could easily affect market or the economy more so than some of the other things they could do.
Hey, Ira, I'm wondering where you think we may see some kind of tantrum. If we don't see it in the bond market, and I know you're going to say you're a bond guy, not an equity guy, but do we see it in tech? Like, do we see it in certain areas of other markets?
Yeah, I think it winds up being, probably a little bit more interest rate sensitive areas of the market. So maybe it's tech a little bit, but I think it's going to be probably in the slightly more levered sectors as opposed to the less levered, growth related sectors. I think something I'd like to go back to on something that Mike talked about just a second ago, and that's what happened at the end of quantitative tightening. And in September of 2019, remember we had what I call the repo hiccup, where you had repo rates spike. Mike, one of the things that the Fed's done in the interim is they created a standing repo facility. So what this does is this allows banks and some other financial institutions to actually get reserves on demand when they need it. So one of the lessons that was learned from the last time the Fed did QT is probably not going to be as problematic as the Fed does start to reduce its balance sheet. And again, I think that they'll do it passively. So it's going to take a very long time for their balance sheet to go down by a couple of $1 trillion.
Mike, this is rear view mirror stuff. We're looking back at a discussion that has already happened. I'm interested in the discussion that is going to happen going in to 2022 as we work our way through this year. Over the last few days, and this is just anecdotal, I'm just kind of listening to the conversations around me. The transitory conversation seems to be coming back. There is increasingly this narrative that the Fed will struggle to deliver 3 hikes this year. The talk of QT is way over kind of where we should be. What are you hearing? What are you picking up in terms of people's analysis of where we're going and when inflation peaks? Is it now? Is it later on in the year? What kind of inflation are we going to get as we work our way through this year? It just feels as if we're kind of back to a discussion that maybe actually transitory is the word we should be focusing on, not retiring.
Well, I think you have to realize that, as the old saying goes, markets go up, markets go down, and they price things in a lot faster than the Fed moves and the Fed offers its views. And so you have this constant shifting. And the Fed has been saying for some time now that it probably needs to raise rates in 2022. The question was always how many times. The markets got maybe over their skis. The feeling is inflation is going to start to come down, partly because of a base effect in the first quarter and the first half of the year, but partly because maybe Team Transitory was right, and we won't know for some time about the impact of inflation, that it's coming from a lot of things that will disappear as the economy normalizes. And you could see that in the last couple days. We had the ISM prices paid number come down a lot, and then yesterday the auto industry reported disappointing sales for the month of December. And this morning, the mortgage bankers reported the lowest number of mortgage applications made since January of 2020. Now, obviously, those things are skewed by the holiday, but the trend is clear. At this point, it looks like the interest rate sensitive sectors of the economy were propped up by the government's stimulus in the middle of the pandemic. And now that that's gone, we're starting to see things fall back. And so that lends credence to the idea that the Fed may have it right. The question then becomes how far do they have, how right do they have to be? How low does inflation have to come down before people react?